Have you ever looked at the crypto world and just thought, man, this game feels rigged? Well, today we're diving into XEN Crypto, this really fascinating experiment that was designed to be the ultimate fair launch. But what happens when that kind of pure idealism smashes into the chaotic reality of the open market? Let's get into it. So first things first, when you look at XEN's value, it seems like nobody can agree on anything. Seriously, the market is completely all over the place. And I mean, just look at this whiplash. On one side, you've got a computer model that's looking way out to 2027 and seeing this absolutely massive, like 8,800% potential gain. But then you turn around and a different model predicts a nearly 25% drop in just the next 5 days. It's like the market has a split personality. And it's not just the algorithms that are confused. This exact same tug of war is happening with real-life traders. You've got one group over here shouting, 50x potential, let's go, while another is pointing at the chart saying, whoa, hold on, that's a bearish pattern, this thing could drop 40%. It is the very definition of a house divided. All of this confusion, right, this deep split, it brings us to the real mystery. What is it about this one project that creates so much chaos and so many conflicting signals? That's the big question we're going to unravel. All right, so to really get XEN, you first have to understand the problem it was built to solve. And that problem is the classic kind of rigged crypto launch. You know the drill, right? A new project comes out, there's a ton of hype, the price goes parabolic, and then, like clockwork, the founders and the big VC funds who got in early dump all their tokens, leaving regular folks like us holding the bag. It's a cycle that just kills trust. And this is exactly where XEN comes in, positioning itself as the total opposite. I mean, the difference is just night and day. On the left, you've got the standard playbook. The team gets a huge stash of pre-mined tokens, VCs get special backdoor deals. But XEN on the right, they just toss that entire rulebook out the window. 0 tokens to start, no insider deals, no admin keys. It's free for absolutely everyone to create from scratch. Okay, but how do you even pull that off? How do you launch something with, well, nothing? That's where their unique mechanism comes into play. So the whole system is built around this idea called proof of participation. Now, you've probably heard of proof of work, right? That's what Bitcoin uses. It's all about who has the most computing power. And you've heard of proof of stake, which rewards whoever has the most money. Well, proof of participation rewards something totally different, something we all have, time and commitment. And the process itself is incredibly simple. You connect your wallet, you choose how long you're willing to wait for your tokens, could be 1 day, could be 1,000, then you pay the network gas fee, and when your time's up, you claim your XEN. The whole point here is that the system rewards your belief and your patience, not the size of your bank account. Okay, so you've got this pure idealistic philosophy, but what happens when you unleash that into the wild, chaotic jungle of the open market? Well, things get messy. And turbulent is putting it mildly. Right after it launched, it was so popular, it caused this massive spike in Ethereum gas fees. But then, the problems started. It got hit by exploits. One person managed to mint over 100 million tokens for next to nothing. Even worse, it got hit with a huge Sybil attack. That's where one user creates thousands of fake wallets to game the system. It was so bad that around 80% of the addresses were flagged as fakes. All of this just feeds into the wild price volatility we see. And this isn't just some abstract concept of chaos. Let's put a real number on it. In just the last 90 days, the token's price dropped by 61%. That is a massive swing. It's the real-world consequence of a completely open, unmanaged system. But there's another, more subtle thing going on here. A powerful psychological trick that can be incredibly misleading for investors. Take a look at this. For just $100, you can buy over 9 billion XEN tokens. Doesn't that just feel substantial, like you own a massive chunk of something? That feeling is a really powerful hook. And that feeling, it actually has a name. It's called a unit bias. It's this funny quirk in our brains where we prefer to own 1,000 whole tokens of something cheap instead of, say, 0.01 of something expensive, even if the total dollar value is exactly the same. Our brain just likes the big number. It feels better. And you better believe some crypto projects deliberately use this against people. They'll create a gigantic supply, trillions of tokens, just to keep the price per unit at a fraction of a penny. It makes the coin look like a steal, like it has all this room to grow. But think about it. For a token with that kind of supply to ever reach $1, its market cap would have to be bigger than the entire global economy. It's mathematically impossible. And when you put all this together, the market chaos, the attacks, the psychological traps, you land right on the central tension, the core paradox at the very heart of the XEN experiment. See, XEN was created with this really noble idea, a truly fair crypto with no insider deals and no central team. But here's the paradox. The very things designed to make it fair are a double-edged sword. The lack of a central team, the lack of a treasury to support the price. That's exactly what leaves it so vulnerable to the market's chaos. And that leaves us with the ultimate question. Does the very design that makes XEN so fair, its uncontrolled, unmanaged, hands-off nature, inevitably lead to the kind of chaos that could scare away the very people it was trying to empower in the first place? It's a powerful reminder of that deep tension between radical fairness and the practical need for stability. And that right there might just be the true cost of a perfectly fair launch.